Your problem isn't that you don't understand Power of 3, it's that you don't know how to execute with it consistently in the live markets. The Power of 3 is one of the most powerful concepts because it works on any time frame, any asset class, and can work for you with any strategy you decide to use. By the end of this video, you will understand what the Power of 3 is, how I use it in my daily strategy, and how to use it to avoid poor setups and over trading. But before we get into the video, why should you listen to me? If you don't know who I am, my name's Kyle, otherwise known as JadeCapFX, and I've been trading since 2011. I found ICT in 2017 and then prop firms in 2020. Since then, I've made over $1.2 million from trading. And if you don't believe me, check out my pinned Twitter post where I've posted every single certificate I've received over the last 2 years. And if you want the step-by-step PDF that I've used to help me make over $1 million, make sure you check out the link in the description. Now, without wasting any more time, let's get into the video. Alright, before we get into the Power of 3 hacks that will instantly improve your win rate, first we have to understand what is the Power of 3. Now, if you haven't heard of the Power of 3, basically we have accumulation, manipulation, and distribution. And this is the flow of how a candlestick is actually forming. So each candlestick, whether it's on a daily time frame, whether it's on a weekly time frame, whether it's on a 1 hour time frame, whether it's on a 5-minute time frame, every candlestick will form the same. So we have our open, we have our low, high, and close, right? So we have OHLC. Now, each candlestick, we want to split into pretty much thirds. So the first 30% of the formation of that candlestick, we should see accumulation or manipulation, right? The second third, more so manipulation, and then the final third should be distribution. So if we're just thinking about from a timing perspective, let's say if we're only trading the daily chart, the first stage of accumulation should occur, let's say within the first 8 hours. All right, so we have 24 hours in a day. The first 8 hours, we should see accumulation. Manipulation will come in the next 8 hours. Right, so now we're at 16 hours, and then the distribution should come towards the final half of that daily candlestick. So that final distribution phase, let's say if we're looking at our 5 p.m. Eastern close, the last 8 hours of that candle will most likely see the distribution phase. Yes, it could come earlier, which is what we're going to get into later on in this video. That's going to be a hack that I determine when is going to be a low probability condition and when to avoid these specific setups and when not to use Power of 3 or when Power of 3 has already occurred. So when we're talking about accumulation, we're going to think of the first third of that candle formation. Now you can split it up into quarters if you want with quarterly theory, but when we're talking about the initial accumulation, when that next candle opens up, most of the time it's going to put a range in or it's going to be very sideways. So when we're thinking about a daily candle, right, the daily candle will close at 5 p.m. and reopen at 6 or 7. And then that accumulation phase is going to be our Asian range session. Now, this consolidation, which I'll get into in the next couple slides, doesn't necessarily need to be the Asian range, because sometimes we have trending Asian ranges. So it's just about identifying where that initial consolidation is starting from. You know, it could be the previous week, maybe the whole previous week. From a monthly standpoint, maybe the first week of the month might be the accumulation phase. It's just about identifying when is that initial consolidation building up, because that's what we need to see to identify when liquidity is being built up. If we don't have a buildup of liquidity, then we can't expect a solid manipulation to induce people into the marketplace. Now, manipulation is going to be a run on the liquidity or the consolidation. So run on liquidity of the consolidation. Think second third of the candle, right? So we need to see accumulation in the first portion of the candle, and then manipulation on the second portion of the candle, or the second third. So when we're thinking about a bearish candle, 99.9% of the time, a bearish candle will start out bullish. Now, there are certain cases where we aren't going to get an upper wick, but those are very rare. And those are times where, you know, you might use that level as an inefficient level that it can trade, that the market can trade to at a later date, which I'll create another video on. But every single bearish candle, or majority of bearish candles, right, start out bullish. And the majority of bullish candles will start out bearish. That is our manipulation leg that we're looking to position ourselves in. And if we miss that manipulation leg, oftentimes we've already missed the move. So when we're trying to position ourselves inside of a candle, this is what we're trying to depict with Power of 3. And this is one of the biggest concepts that I use in my trading. This idea pretty much trumps everything else that I have going on. If I can understand what the power of 3 is and the direction of that next candle, doesn't matter if it's the weekly candle, doesn't matter if it's the monthly candle, doesn't matter if it's the daily or the hourly candle. Okay, and I'll go into some examples after this. The distribution phase, we should already be positioned before the distribution phase occurs. So it's all about identifying the accumulation, when they're going to run out that accumulation. That'll be the manipulation leg, and then distribution, which is going to be our expansion, which should come in the final third of that candle. Right, so when we're thinking about an hourly candle, a lot of times you guys might see a final push on the last half hour of that specific candle, right? Or even the last 10 minutes. The last 10 minutes, you might go from a bullish candle to a bearish candle and vice versa. So when we're thinking about how the candle's forming, oftentimes we want to wait. As soon as that candle opens, we want to wait and see how the market is going to trade. Many times, if you're a day trader, if you're just trying to anticipate the next hour or 2 hourly candles, all we have to understand is, all right, if I'm trading from 10 a.m., let's say if I'm trading futures, right? If I'm trading the 10 a.m. to 11 a.m. candle, as soon as that 10 a.m. candle opens, I want to actually see it trade against my initial bias. So if I'm bullish, I want to see that hourly open. I want to see price trade below the hourly open. And I'll get into the examples just in a little bit, but hopefully you're following me here. Now, accumulation, right? We should see a tight range that forms at the candle open or form previously to the current open. It doesn't necessarily need to be the Asian range is kind of what I'm getting at. It could be, this accumulation could come from multiple days. We might have multiple days where we're in a consolidation, and then one specific day where we have news taking out one side of the accumulation. All right, so the origination point doesn't matter as much, only that there is some type of consolidation to reference. We need to see some type of consolidation being referenced. All right, and this kind of all ties into market maker buy models and sell models, which I'll do another video on, obviously. So, i.e., an example, the Asian range, or maybe the lunch hour, or maybe the previous daily session. Okay, so it doesn't necessarily need to be the Asian range. And you guys will notice as you're forward testing, back testing, it's not always the Asian range that's going to provide the consolidation. It's just about identifying a specific consolidation. All right, so that was our accumulation phase. Our manipulation phase is we're going to wait for a run on liquidity to induce sellers or buyers into the market. The liquidity may be a previous monthly high or low, a previous weekly high or low, a previous daily high or low, or a previous session high or low. So these are all of our time-based liquidity levels. We need to make sure that we're understanding where is the next level of liquidity. Obviously, the higher time frame liquidity pool will have the greater importance. So if we sweep out a previous monthly high or low, we can obviously expect a possible larger reaction from that specific level than if it were just the Asian range low or the previous session low. All right. So this is our depiction. We have the accumulation. The inducement will come if we have a bullish bias, right? It will come after we've taken out one of these lows in here. So we might take out previous monthly low, previous weekly low, or a previous session low. This is just a bullish example. All right. So bearish, you're vice versa. So distribution. In this case, once the sellers have been induced into the market, smart money will accumulate longs below these old lows or below an old consolidation prior to the distribution or expansion phase. All right, so this is exactly where smart money is going to accumulate their longs. This is where dumb money has their stops. So dumb money will have their stops resting below the low, and then they'll be induced into the market. So either they're going to be stopped out or new sellers are going to be induced into the market. My apologies. So new sellers will be induced in the market. Dumb money that had previously entered early will be stopped out. And then the smart money will be accumulating those stop orders or people getting induced in the market. So if they're selling, I'm willing to buy it from them. All right, so I want to position myself below these old lows. Now, let's get into an actual chart example and how we're actually going to think about this. So this is just an example on the euro. Now, this works on every single asset, every single time frame. Okay, so if we're just thinking about a next hourly candle, we should be thinking very similarly to how we're thinking right now. But this is just an example on the daily time frame. So as you can see, we have our midnight open. This is Tuesday, August 13th. We have our midnight open. We've taken out Asian range lows, but you guys can see that we've taken out the previous daily low. And if I were looking at this this price action, this entire day on Monday, was our accumulation phase. So a lot of times you can use Monday's range as your accumulation. So it's not necessarily just the Asian range. It all comes around context. Maybe if we did have other PD rays resting below the Asian range and we kind of were running into that level ahead of New York session, possibly we weren't going to run out the Monday low. But what we need to see is a specific setup that appears after we've taken out liquidity. Okay, so after we've taken out this, let's say if we were to try and position ourselves long and we were only going long after taking out the Asian range low. Well, we don't have a market structure shift or a bullish fair value gap or anything to key off of to determine that the order flow is shifting bullish. And that's really what we're targeting. We want to anticipate that this day is going to be bullish, but I need to see some reasoning on the lower time frame in order for me to get bullish. So the first signature is running out this liquidity. So I'm going to just type this out. So our first confluence signature is running out previous day low. That's my first sign. Okay, once we've taken out that low, now what? Well, 2 is going to be market structure shift. This, to me, in my opinion, is really all I need to see in order to get long. There's some other levels in here that we can obviously dial in, like this inverted fair value gap in here, right? You guys can see, if we zoom in here, we had this sell side imbalance be inverted, and then we retest at that level. We also have the market structure shift, or we have this buy side imbalance that never traded to again. But once we get further into the day, I'm going to discuss, why, if you miss these moves, sometimes they're not efficient for you to enter the market. So we have our previous day low, we have our market structure shift, and then we're trying to find a position to get long. And this is where I'm going to let you guys know that the entry doesn't need to be as precise as you think. If you see signatures in price, I don't necessarily wait for the exact pinpoint entry. If I get enough information that is leaning in my favor, all I'm trying to understand is how can I position myself inside of that higher time frame wick, which is what we'll get into in just a second. Okay, so once we get that market structure shift, maybe you want to try and position yourself long. And there might have been news at 8:30 on this specific day, which I'm sure there was, because we had this nice run higher. Now, what exactly are we trying to look for? So depending on what your model is, right? So first of all, have a bias. Second of all, how do I position myself inside of that higher time frame wick? Well, I need the market to trade lower, right? If it's trading above the midnight open, we don't have necessarily the best efficient price. And this is where I'm going to get to when it comes to specific hacks that you guys can do to instantly improve your win rate. So using the power of 3, having the power of 3 in mind when it comes to positioning ourselves in the market. Now let's just say this is our daily candle, and this is what we're expecting. So just at the time of this this market, right, we've already seen the day expand higher. But let's say if we're right around the midnight open and we are just expecting it to go higher, we don't know if it's going to expand higher or not, and we were entering somewhere around here. Let's say we just entered somewhere around here, and we're kind of near the midnight open. Well, we have to think about how far has the market actually expanded for me to get efficient pricing, which I'm going to talk about right here. Okay, so when we're talking about positioning ourselves in a power of 3, I'm only concerned with this daily candle, right? Everything that I'm seeing here is just a depiction on the lower time frame of smaller segments of data. So this is the 15-minute candles, 15-minute chart, but it's making up this 24-hour candle. All right, so we're going from midnight to midnight. But in order to get this 24-hour candle, right, where is there going to be the best pricing? The best pricing for me to get long is going to be below the midnight open. Now, this is exactly where we need to be operating. On a day-by-day basis, if we want to increase our win rate, we just need to understand that operating below the open, anywhere in here, is going to be way more efficient than if we were to enter longs above the open. Because I will tell you right now, if you are trying to position yourself after the market's already expanded above the midnight open, and this is just an example where it's worked, but I will guarantee you that your win rate will not be as high if you are going long after the candle is already green. So in order for us to increase our win rate and avoid certain trades where the market's already expanded away from that specific open, my biggest tip is to understand where you are as part of a daily candle or whatever that higher time frame candle is. You guys can say that this is going to be an hour. So like if you were to, let's just pretend that this was from 11 a.m. to noon. Is essentially the same thing that you would do on the lower time frame. Is if that next hour opens, let's say this is the 10 a.m. The 11 a.m. open, right around 11 up until like 11:20, we want to see the market trade lower and then position ourselves before that candle expands higher. And if I don't, let's say if the market already pushes above the previous hourly open, now all of a sudden my probabilities and my opportunity as far as risk reward goes down. So things that I avoid is when the market is already trading above the midnight open. By the time I come to my charts, many times I'm just passing on those trades. A lot of times, because when it comes to efficient pricing, and this is where I want to be smart money, right? Any price above the midnight open is not as efficient. Let's just say there's a whale. This guy really knows how to trade, and he's getting in at 1.0920, right? Let's just call him Bob. Bob's entry is at 1.0920, right? And let's say me, Kyle, I want to enter at 1.09468, or let's say 1.09500. This is my order. Who's getting the more efficient pricing and the better risk reward out of these specific setups? So let's say Bob entered here, and then he placed his low, let's say, I don't know, maybe a little bit below the daily low. Let's say he got in, I don't know, and even anywhere up here. So this is below the midnight open. Let's say he got in right around here, put his stop maybe at the weekly open. That's this blue line here. And he's targeting, I don't know, let's say a 3-to-1. Well, he can get that pretty easily, right? This is Bob's order. And let's just say that I'm going to go long, but I'm not getting in till here, right? Above the midnight open. Well, where do I have to put my stop loss? I have to put my stop loss maybe here or even down here. So let's say even if I'm pretty aggressive and put my stop loss here, well, how much room do I have to squeeze this trade? Let's say I'm going to use the same target. I'm only getting a 1-to-1. All right, so not only am I'm at greater risk because look how wide the stop is. My chance of success actually goes down because there's not enough room for that candlestick to run. So when you guys are coming to the charts and you're looking at a power of 3 setup, if you're bullish for that following day, but we're already trading, let's say a couple standard deviations above the midnight open based on the Asian range. Let's say if you're trading up here by the time New York session comes around, most of the time I am just doing nothing. All right, and that's a major hack that I want you guys to understand is I want to position myself inside of the higher time frame wick, and you can only do that if you're comfortable going long when that higher time frame candle is bearish, because when the market is trading lower off the midnight open, this candlestick is not green, okay, it's black. So that's just definitely something to be mindful of. And this is where I think power of 3 is so easily people disregard it because they kind of think that, oh, maybe the power of 3 it just doesn't work. Well, it does work. It's just maybe you're late to the party. And this is kind of where I differentiate myself from other traders possibly, is where all I'm trying to do, and this is kind of where I keep my trading as simple as possible, because all I'm looking for is that range of the next candlestick. So even if I'm trading the daily chart, I only care about the next 24 hours. Or if I'm only trading the hourly chart, well, I only care about the next 60 minutes. If I'm trading a weekly chart, I only care about the next 5 days. And this is where it's going to separate you guys. This is where it's going to separate you from being a inconsistent trader where you're FOMOing into trades versus somebody that's very patient and waiting for the right setups and waiting for the right time windows. Because I guarantee you, if you wait for the right time windows, let's say news is coming out and you're waiting for the right time windows, you don't really necessarily need to wait for confirmation. Some of my best trades have come from just going long after it's hit a specific standard deviation, and me expecting that the market can't go any higher because we've already taken out a specific level. We're trading at one side of the open. So many times, some of my best trades right? There's no confirmation setup. I'll just go long based on the price. Okay, so let's say if we took out this previous daily low, and even if we don't get a market structure shift, just buy it based on the price and put your stop loss at a specific level. Maybe it's a couple pips below the previous daily low or below the low that was just created after taking out the liquidity. When you do it this way, you can almost trade blindly and have a better win rate than somebody that's chasing trades after they've already occurred. And I know there's a lot of you guys listening that might be doing that. You see this daily candle trading higher, 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 and you want to hop on the trade, and then all of a sudden the next day comes out, and what do we get? We get another power of 3 setup where it just trades back into the range of the previous day, right? It sucks in sellers into the market, so induces sellers into the market. They position themselves long again below the open, and then all of a sudden it's ripping higher. But because you got in early, you've been stopped out because you don't know where exactly to put your stop loss. So having patience waiting for those next setups to appear is going to be so, so, so important. And if you come to the charts and you've already seen the market expand in your direction, you're way better off just sitting on the sideline, especially if the opposing end of the wick of that specific candle has already been created. Okay, so let's summarize a couple things. How I trade power of 3. Right, establish a daily bias from the high time frame chart. Now you guys can replace this with whatever time frame you want to use. Establish the 1 hour bias from the high time frame chart. Right, if you're a day trader, you really only want to focus on the next 1 to 2 to 3 hours. All right, if that's your time window, you are only focused on right, what's the next hour going to do? If the next hour, if I'm expecting it to be bullish, what I want to see is the market trade lower first. Okay, if it trades higher right away and then it takes out the previous hourly high, there's a very high likelihood that the market is going to retrace on you. That's what I don't like to see if I'm expecting a specific move. So if I'm long already and the next hour opens up and it trades higher straight away and it doesn't trade lower, creating that lower wick, well, I know just from a probability perspective that there's a very high likelihood that it's probably going to trade below the open again. And in that case, if I'm already up a certain amount, I will try and take partials or just be more mindful that this market could possibly turn around on me. All right, so establishing the daily bias and understanding, using the power of 3, how the next candle should start forming. All right, determining a level of liquidity we want to see manipulated. That's going to be based on experience, based on you identifying those specific consolidations, and then having the patience long enough to see those specific consolidation levels be rated. Okay, so no raid, no trade. 3 is identify setups at an efficient level of price action once liquidity is rated. Now, that is extremely, extremely important. My A+ setups will occur. If I'm bullish, they will occur below the open. If I don't get the setup below the open, I automatically grade it lower. So if I were to grade my trade setups from A to B to C, once we are above the open and I'm bullish, it automatically gets graded as a B or C because I've already missed out on the most efficient price action unless the market trades back below the open, okay? Which oftentimes I don't like seeing that happen, especially if we've kind of already had a strong move away from trading lower. All right, that's our Judas swing. So number 4, entry should be on the opposing side of the open, right? Like I just spoke about, compared to the established bias. All right, so the further price moves away from the open, the less risk I should use, and the lower likelihood of me succeeding in that trade happens. So, you know, this is just something that you guys can test, and this is where you're going to instantly improve your win rate. If you were to only trade long positions after the market's already traded higher above the open, I guarantee you that your win rate's going to go down, and then your overall, your average risk to reward is also going to go down because you're missing out on the smart money wick. So the wick is really where the smart money is operating. If you can position yourself inside that higher time frame wick, I guarantee you will instantly improve your win rate, and you will instantly increase the profits that you're getting from your trades. So when to avoid setups, obviously, is when price has already expanded away from the open in your predetermined direction. Now, this is just something that you guys need to build discipline on. When that market expands away, you need to just sit on your hands because if you already missed the move, don't FOMO into the trades, all right? I hope I helped clear up some of your confusion when it comes to using the power of 3. If there's anything I've learned over the past decade plus of trading, it's that you will only succeed if you're serious. That's why I'm looking to work directly with the most serious traders to help you improve your trading. I'll provide everything you need to take your trading to the next level, including multiple live streams each and every week with live trade executions, direct access to ask me anything you want, and a top tier community filled with like-minded traders. If this is something that interests you, make sure you book a call using the link in the description. Also, don't forget to like, comment, and subscribe to the channel, and I'll see you guys in the next video.